All right, what is happening? This is Colin Andrews Egbert, and this is Buying Beautiful but Boring Businesses. And today we have an individual and this is one of the things that I love about this whole community, about people, is that from all walks, from all different varieties of background, from all nationalities, everything. You have folks that are coming in that say, you know what, I want to have a piece of the quote unquote American dream, and I want to get I want to have some businesses under my belt. And we have Sreenath, who he comes from a Microsoft background, IT, very tech, very smart individual on the the left brain, the technical side of things, and had a career in that, and then decided to transition to buying beautiful and boring businesses, and has done 2 acquisitions. And with those 2 acquisitions, we're going to dive in. We're going to learn a little bit more about what he's been able to do, how he's been able to do it. One of the deals, I believe it was just one that he did SBA lending as well. So we'll dive into that as well and go from there. So Sreenath, thank you very much for joining us. Anyone that's listening to this, they're maybe just a step or 2, or maybe they have a business they're looking at doing additional businesses and looking to understand how to do it from individuals that have taken the path. So thanks for joining us.
Hey, great to be here. Thank you so much for inviting me over this podcast. I'm super excited about this. Like, I'm happy to share all my learnings and all my mistakes, right? So that you don't, or your audience don't need to repeat it.
Let's do it. Well, Sreenath, you've worked at one of the most, prestigious tech companies there is. Microsoft. I would put Microsoft, Tesla, Facebook. That's kind of like the holy grail, right? These Google, those are the kind of the holy grail of companies. You were at Microsoft. I'm sure you were making a good salary. I'm sure you had a certain level of creature comforts and such. Why branch out from that? Why decide that, hey, I'm going to go out and venture a path of my own. I'm going to go look at buying businesses. Why did you decide to do that?
Yeah, great question, Colin. I think as an individual, like, I always had this itch around entrepreneurship, building something of my own, for few reasons, right? One, financial independence, plus just the passion towards building something new and owning it, like being your own boss, right? I had tried like few things that was somewhat successful, and few things that were clearly not successful, right? So one of the things that I realized as I went through my journey is that it's really hard to build a successful company from scratch. The 0 to 1 is like incrementally hard. It's like saying, right, it's really hard to get your first customer, and then to get the 100th customer is still harder. But from 100 to 1,000, and from 1,000 to 10,000, it becomes easier and easier, right? I think that logic applies clearly for like building new businesses, and the statistics says the same thing, right? There are so many, like, I don't remember on top of my head, but there are so many experts in the industry talking about the failure rate of new startups, right? As I was going through that journey, I read this Buy and Then Build book, and I quickly realized, like, I am looking at it wrong, right? There are so many businesses out there. They have gone through the stage of like 0 to 1. Now it's all about getting from that 1 to 10. And as like with Microsoft or any other company, your experience actually makes you a better operator. You know the nuances of how do we really scale a business, right? So I thought my profile fits a lot more there. And that's what actually got me into my first business.
Got it. Understood. And when you made the decision, okay, I want to buy a business, I know I want to start one. What made you decide on your first business, the type of business, and tell us a little bit more about that first acquisition and your mentality for going and taking that path, that sector, and then specifically that business.
Yeah, that's a great question again. Initially, it was really hard for me to know what business to go after. I started looking at some of these portals. I started talking to a lot of brokers. Many business appealed interesting to me and kind of fits my profile in some form, because a lot of my career I had done marketing. So I always think from the aspect of, hey, how can I apply marketing to this business to scale the business, right? So marketing is like a vertical skill set where it can be applied to many different business. But then as you start looking at some of these business, you get a good sense of, hey, these are the businesses that you wanted to focus more of versus these are the businesses you don't want to focus on, right? We call it as a buy box, but back then I didn't really know about that, right? I mean, you really thought about, hey, if it's a good business, if it's an interesting business that you're passionate about, you start talking to the broker, you start talking to the seller, you try to put an LOI on it. And then you go through the cycle like multiple times. And in my initial stages, like I ran into this problem of like most of my LOIs were rejected. Either I undervalued the business or it was a great business and there were so many buyers more qualified than me bidding on it, right? It's really hard to close the first business though, right? So that process of constantly like talking to people, applying or not applying, like putting together LOIs, talking to brokers and trying to figure out which is the right business for you, or just getting through that process of like a signed LOI was the most difficult phase. Like it took me like probably 6 to 8 months to get to my first signed LOI that I started working on. And that ended up to be a marketing agency, which was the right fit for me.
Okay, great. So as a marketing agency, that was your first deal. Now, Sreenath, you know the numbers, the statistics, like 9 out of 10 people that want to buy a business, they don't do it. They get in, they spend, $10,000 on a coaching program. They send out one batch of letters, or they talk to 10 brokers and only 9 of them actually get back to them, or, actually give them the information that they want. Like there's significant roadblocks that occur. How did you put yourself into the 1 out of 10? You said that you've had some challenges. Like, give me a little bit more of like the mindset. Was it like, I'm going to make this thing happen? Did you talk to a lot of other individuals that made it work, that gave you the confidence? Do you have a little bit of an ego that says like, look, like, I got my Microsoft chops. If I can work there, I can do this. Like, give us a little bit like an insight of your mindset that allowed you to be in that minority of actually going out there and doing it.
Yeah. I don't think I have a good answer for that, Colin. It's just pure hard work and pushing yourself. I don't like failures. I actually worry a lot about failure personally. Even in my corporate job, I always think about, hey, if I don't do this extra step, like, how would I be perceived, or will I end up as a failure? So failure always bothers me in my inner mind. So I work really hard towards it, and I hate failures. To fail, which made me work harder. And eventually, like, after 6 or 8 months, like putting it again and again, like these LOIs, like eventually one of them like worked out, right? But here's the other thing. I didn't have a community, right? Like the community that we are part of. So I made a lot of mistakes on my way. What we call as a deal heat. Like I overlooked a lot of like red flags in a deal, and I ended up signing up on an LOI that in retrospective, I shouldn't have done it, right? So that was a very costly mistake that I made, but it helped me evaluate deals. It helped me like push through some of these roadblocks. It all comes from the need around how much you really wanted it, how much personally for me, I was like hurt by my failures of not getting good businesses that I cared about, right? That pushed me harder and harder. And I ended up making compromises. Like I overlooked red flags to acquire that business. That was a big story around it. It all comes down to commitment, how much you really want it, and pushing hard towards it.
Got it. So it wasn't like that you went out there and that you had this background and experience that allowed you to avoid all these mistakes. It's like, I went out and did mistakes. I went out and had issues. I went out and had deal heat, as what we call it, when, you're a little bit too overly invested in the success of a deal going through. All of these things, like you went through it, yet you just kept on going. Like you just didn't quit. That sounds like having that grit, as we like to call it. That was a big piece for you to really get over the first deal, especially. So that's great. That really kind of goes along with a lot of the things that we're taught, as far as just keep on pushing. You're going to screw up. Your first deal probably is going to be the best one that you do, but it gets you in the game. It gets you, really, you get to put on the hat that you're the business owner, right? So that makes a lot of sense. Tell us some of the numbers, like what did you buy it for? What were the numbers? Give us a little bit of insight on the digital marketing agency that you're comfortable with sharing. And then also, like, I want you to take off your humility hat a little bit and say, like, when things go right and what you're doing with it, like, what can you sell it for? Like, what kind of equity are you building within this business on an enterprise value?
Yeah, totally. So that business was valued around $1 million. I paid like 30 to 35% of it as a cash, like, buyer injection, and the rest was a seller note. So we couldn't get bank finance on that business. Part of it is that the business was too small and it didn't have a lot of history. And there were some other numbers like churn, for example, in the marketing agency, it's a big killer. So churn was a metric that I actually overlooked. I felt that, with my Microsoft experience, I can really fix this. Okay, it's not a big deal. So the multiples were in the 2.75x kind of range, and a lot of it was like seller financed. So what we ended up doing is, right, when I took over the business had a lot of problems, like churn being one of the biggest ones. We worked really hard. We couldn't fix churn. We pivoted the product offering multiple times. Eventually, right now, we started seeing some success. So it took a while and it was a wild ride. It took a while for us to actually really fix some of the hardcore fundamental problems associated with that business. But I think the good thing was, like, the second business, when I acquired the second business, it was much easier. A lot of the brokers were interested in working with me. They bought in deals that were more growth oriented deals, that is like much more fundamentally strong businesses. And I was able to close business that I liked fairly fast.
On the second one you're talking about.
Correct. Exactly.
Okay. Yeah, because usually you think that the seller financing deals are easier to do or the faster, and that the SBA is a huge headache. So before we go on the second one, let's stick on the first one for a moment. So with the first one, you bought it for $1 million. What's the goal? Are you looking to exit it in the next year or two? Are you looking to just hold on to it for cash flow? Like, how's this story going to end at the end of the movie credits? How's that look? And obviously you don't have a crystal ball, none of us do, but what do you see for it, or what are you going for?
I think right now, what we have ended up doing is we pivoted it from a marketing agency to more of a, previously within the marketing agency, the focus was heavily on Facebook ads. Right now, we have started expanding the number of services that we provide to a more holistic package. And we have starting to go after a different segment of users. So really what we see as the future growth is like, we feel we are starting to hit a product market fit on that particular business and the product offering. So the idea would be to continue to grow the business over a period of time, some equity in it. And then, it's good for a cash flow, but it's also interesting that marketing businesses, it is like a supplementary business to many other type of business, right? You could use marketing business as a platform business and acquire like related businesses, and then, put these businesses together under a holding company to make it more interesting for cross-sell, upsell opportunities, and then take it back to the market, right? So there are lots of opportunities. Right now, the thought process is really around, hey, how do we continue to grow the business for the next 2 to 3 years, get the delivery engine really working, make sure the product offerings are strong, and then start acquiring other marketing agencies or related businesses that a marketing agency can really help scale.
Got it. Okay. So rolling up additional, maybe even smaller businesses that you can tuck in to what you currently have, or because like what you said, that it can be a complementary business to something else, that you buy a business that's outside of it, but that the marketing business is the first vendor to the other company as well. So that you have kind of a way where a marketing business can provide services to another business. Is that what you mean?
That's correct. That's correct.
Got it. Okay. Very interesting. Very interesting. Now, when most people, when they think about, owning a business, they think it's going to take up all their time, that's going to be full time from wake up to going to sleep. And what you were able to do was to not just buy one, but you were able to buy a second one. So when was the second one bought? And for all the people out there, like, how is it even possible that you can buy another business, especially if one was, you had $1 million, you didn't have a huge team behind you, you didn't have, multiple layers of management. How were you able to have the time, energy, effort, and the finances to go out there and get a second deal, the SaaS deal? And can you kind of share a little bit more about that deal and how you got it?
Yeah. So I don't spend a lot of time on the marketing agency anymore. We have a strong team in place and the team is self-sufficient. I spend like probably 4 to 8 hours a week, like half a day to a day in total time a week. because I think the key for any business is that you want to hire really good people and they form your fundamentals, right? As long as you have the right set of people, and then the problem is making sure you have good data and a good strategy in place, right? So once we solve for or directionally solve for these three problems, like these three problems are never fully solved, but as long as you are directionally solved, you have a good operator, have a good team, good strategy in place that doesn't need to be changed immediately, and you have reasonably good numbers to validate, it becomes a more of a self-sustaining entity, right? So so that's what I rely on right now. Acquiring the second business was a function of I want to do more. I want to find new businesses that are interesting. So on the financial side, fortunately, from the corporate job, I had enough of a finance to support that acquisition, at least the down payment. That deal was a much bigger deal. It was like valued at 2.7 mil and it had much higher cash flow. So again, that business, interestingly, that the owner of that business ran it for almost like 5-7 years, and he was mostly in a semi-absentee mode, not actively working on it. So I got a business that was fairly successful, well known in a particular area in the SaaS world, and I am spending much more of my time on that business right now.
Got it. And what were the numbers on that? Can you share what was the kind of revenue that was coming in? What was the profits? What was the purchase price, if you're willing to share that?
Yeah. So revenue was somewhere in that 1 to 1.5 million range. Most of it was profit, like profit touched around 600 to 700K. The multiple was around 4x. So we paid around 2.5 million on that business.
Got it. Okay. Yeah. And my understanding is that the SaaS businesses, as opposed to other boring businesses, the home services or professional services, that normally SaaS goes for a higher multiple. So 4 is kind of like right in the range where with other business sectors that, especially if you went to SBA, they're going to say, look, 4 is kind of heavy. We'd rather have you be in a more of a 2 or a 3 range. Is that correct?
That's correct. I mean, it all depends on the DSCR numbers, right? Like, and how the deal is structured. What percentage of the deal is like seller financed versus what percent of the deal is like bank financed debt. So as long as you have a healthy DSCR, you really
Real
need to
quick,
approach.
Sreenath, excuse me. A lot of folks, they don't know what the DCR is. So can you explain the about that ratio?
It's called debt service coverage ratio. Basically, the idea here is when you are acquiring a company, you are validating against how much is the cash flow and how much is the debt payments and what does that ratio looks like. Okay. So you divide the cash flow per month, for example, month or year, divided by the debt, and what does that multiple look like? If it's a multiple of 1, that means that you're just making enough money to pay the debt. People don't like it, right? Banks like it when it is at least 1.25, which means you are at least making 25% more than what your debt payments are. You ideally want that to be in the 50 to 100% range, right? Meaning, if you're buying a business and if the cash flow of the business is twice the amount of your debt, you're really comfortable to actually pay off that debt, right? So that's what the banks look at, like, what does that ratio looks like, right? If that ratio is healthy, the banks would lend for it. Of course, you need to identify a bank that lends for SaaS businesses so that they understand higher multiples are okay. Because you also need to know, for a SaaS business, it really doesn't matter what the multiples are. It all comes down to this ratio number, right? Because once you operate it for a year or so, SaaS businesses grows at a much faster pace than a traditional boring business, right? For example, you take a self-storage, okay? That company might grow at like 5 or 7% or 10%, right? I'm just putting out numbers there. I don't know enough about that business, but traditionally brick and mortar businesses grow at a certain rate, right? It's not uncommon for a SaaS business to grow at like 100%, especially smaller SaaS businesses, right? So think about the year 2. Even if the company doesn't grow at 100%, let's say the company grows at like 25%, right? And your expenses doesn't grow that fast. That's the whole idea of SaaS. Like, you still have a developer, you have a support person. So the expenses are very limited. That growth curve on the expenses is very, very linear or probably slightly trending in the in the other direction. but the growth can happen really fast. So when you look at the DSCR, the number for the year 2, it's going to be very, very healthy, right? So the idea that the thinking really behind that is banks would come in and say, hey, is this guy a strong operator? Is the DSCR, the ratio out of the gate healthy? And do I have enough confidence on this person to say that this guy can actually grow the business faster, which means that starting year 2, year 3, it's a very healthy business, right? Like, or very healthy or less risky from a bank's perspective.
Got it. Now, what I'm hearing from you is that you ran the numbers and that the DSCR was solid when you bought it, but your mentality is because you're in the niche that you're in and because of your background and because of your confidence, you're saying that it's only going to get better and that DSCR, where maybe that cash flow is going to grow a little bit if it's a normal, boring business that's not software, but because it's software, you're really going to be able to pull on the levers as like what we say and increase that cash flow. So that was one of the mentality that you had when you were going into this. And how has that fared so far? How long have you been owning it for, and how much were you able to increase revenues? Has your thesis came true?
Yeah, great question, Colin. I've been running it for the last 6-7 months right now. Business haven't declined. It's starting to grow slowly. That acceleration hasn't kicked in, but there are lots of things from a product changes and marketing that is getting in place, right? So I do expect a period of like 6 to 12 months to really start seeing that growth, because you are getting into a new business, into a new product area, into a new category. You really need to take that transition. Actually takes a lot of time. It's something that typically people underestimate, which is also one of the reasons, like, most of these gurus would say, hey, you want to stay in your lane, because of the fact that it's not just about closing the business, right? There is a lot more to be done after closing in terms of running the business. So people underestimate the effort required during that phase of your life, because you will be soon over with your honeymoon and you have a business and accountability and responsibility. Like, you have to make the payments on time, like, people to be paid, right? So there's a lot that goes in after the business acquisition is done, right? Which is why you need to be in the lane, but the transitional period is like very, very critical. Like, it takes some time to know the business to help grow it.
Got it. Got it. Yeah. One of the things that they mentioned, and just that's kind of known through the business buying community, is what's called the J curve. That you have a business that you buy it, and that then it goes down a little bit, like the J right after you buy it. You're putting in money, you're putting in time, effort, and then that's when you get that J, the part where it starts to really ramp up. And it sounds like that's that's very normal with most businesses. It sounds like that's what happened with yours as well. Is that you had a little bit of you're getting in, you're getting your feet wet. Now I own a business, and now it's like, okay, how can I ramp it up? How can I standardize the expenses that I have, and how can I really maximize the growth? So that makes a lot of sense. Let's talk about, let's take off the humility hat for a second too. So 2 years from now, you have a business, you've grown it, you're now really comfortable with it. Now SBA, with somebody that could be potentially wanting to buy it. Now you have even more of a track record. You bought it for, correct me if I'm wrong, but about 2.5 million. Was that correct? About 2.5. Okay. So 3 years from now, let's just say 3 years, 3 years from now, what kind of offers, what am I going to have to come and bring to you? What kind of offer is it going to take to sell this business? What's the goal? 3 years from now, it's 2025 right now, 2028. What kind of check am I going to have to stroke to buy this software company from you? Give me a range.
Look, I think, there are a few ways to look at this, right? And, there is going to be like, time is going to tell you, like, where it's going to lead, right? But there are typically two ways to look at it. One is like, hey, I continue to grow the business. When I acquired the business, it was 600 to 700K in EBITDA profit, right? I want to push that number closer to 1 million and beyond 1 million, right? I think million is a very interesting mark for a lot of different companies, because what then happens is, at $1 million in EBITDA, a lot of these like bigger companies are going to be interested, right? It's not an SBA deal anymore. It's like PE companies would be interested, family offices would be interested, traditional like trade buyers would be interested, and you get a much higher multiple, right? So part of my goal is within that 3 years to push it to that number and package it back and get it into the market. When right now I paid like 4x, my expectation at that time would be somewhere in that 6 to 8x range, right?
Got it.
So that's what we are
Beautiful.
looking at in terms of it, right? I think that's path number one, right? So the path number two is, the beauty of acquiring a business is that as long as it's going in the right direction and, at cash flowing and it's a cash flow positive, you can actually raise like money against that business to actually invest and buy new businesses, right? So banks would extend line of credits, or you could even refinance, right, with a higher equity value and things like that, right? So basically, this company will form as a platform for you to raise some funds to acquire more businesses in that similar price range, right? Or even the higher price range. So if I can get like more complementary businesses, I can basically combine these two together and then take it to the market, right? So that's
Got
other path to it, right? In that path, again, the idea would be to grow these independently and push to that million or 2 million in EBITDA range to package it and take it back to the market to sell it.
Got it. Excellent. So what I'm hearing is that, and that's one of the nice things is that you can have multiple exit strategies essentially, or multiple decisions on how you want to keep it. If you want to hold on to it, you can capitalize it, essentially get a loan against the cash flow of the company, use it to grow that existing business, but also use it to bolt on other businesses as well. So that's one of the ways, and it can almost be a liquidity event because you can take some of that cash, that loan per se, as quote unquote a profit to you. It's not looked at as a profit because it's a loan, but it's a way for you to recapitalize, to then grow. So that's always what, as you know, my background is self-storage, and having multiple exit strategies, being able to just to hold it, having to refinance it, being able to sell it, being able to sell it with seller financing and then build cash flow. Like, it's always nice to have multiple exit strategies. So that's awesome. Let's talk about the investors. So one of the things that we do with True Oak Ventures is we help investors, limited partners, that they're not ready to do what you're doing. They're not ready to take on the risk of having a business themselves. They're not ready to sign on a loan. They're not ready to deal with all of the stress, the effort. They have an interest in the future, but they're not ready to do it now. What would you say to somebody that they want to get in the game? They don't want to go out there and buy a business right now. They don't want to, like I mentioned, they don't want to sign on a loan. What would you say to somebody like that that's interested in getting involved? They want to have a front row seat. They want to see how a business operates. And then if they like it, then they want to choose to purchase a business, and then they can take more on the risk, the responsibility once they have a ground floor understanding of that business. What would you say to somebody like that?
Yeah, look, there are so many opportunities here. Like I see a lot of operators or people like me who wanted to buy a business do not have enough cash upfront to put for the buyer's injection, right? So for those investors, like platforms like EWS, right, and Deal Wealth Society and platforms like yours are a great place to identify people who have deals and who are willing to give away a portion of the equity in exchange for the buyer injection. Deals, businesses that are good, you feel confident with the operator, and then put that money in, right? And that will give you the front row seat. That will help you understand how the business is running. That will help you, like, it's good for the operator as well because they're gonna learn from you, right? If it's in your lane, you have lot of experience as an investor, like they're going to learn from you. So together you guys will form a good team to help build the company, right? At that point in time, now you have a lot more opportunities. You can continue to invest into more, like you mentioned, or become an operator, or at some point, right, gain more equity in existing companies, right? So there are so many opportunities out there. You want to diversify yourself, you can do that across multiple businesses. These are all cash flowing businesses, and when investors come in, they do get a preferred return rate. So you have some cash flow coming in. They have higher priority in terms of, like, in the assets and the returns. So that there are so many ways you can negotiate a deal with an operator, right? So I would think that's the best path forward if you're not willing to do it right now. And I know there are a lot of people who has like good W-2 jobs, like making like $500,000 to $1 million, like who who were like me, like, a few years back, thinking about, hey, is this a good opportunity? Should I put my feet in? Or, they could do it as an investment to begin with. And then if they find it good, that, they could like continue to acquire more businesses or do it full time, right?
Absolutely. Did you choose to invest as a limited partner with other deals for you to get involved, or did you decide just to go in and really start it on your own and take the bull by the horns, as they say?
Yeah. I I didn't choose to invest because, look, I had this fundamental thing in my mind where, look, I am an operator at heart, and I wanted to be a lot more involved. So I felt that as an investor, it's better to invest in me because I'm passionate about it. I wanted to do it. So compared to, doing it with somebody else.
Got it. Understood.
And that was purely a
Excellent. Well,
personal choice.
Sreenath. Yeah, no, I get it. Sreenath, thank you very much for sharing everything that you did. You really gave us a kind of insight from, your background from the tech and then getting into your first deal with the digital agency and then moving on from the digital agency and saying, I'm not ready to just finish now. I'm ready to expand and let's take on another one with the SaaS business and how you're able to do it and how you were able to scale and what the goals are. It really was you pulling back the curtain on your business and on your journey. And these are the type of things that people, before they start decide that they want to invest into a company or that they want to buy one for themselves, they start doing this type of research. And I'm sure that on your journey, you did the same thing as I did, is start learning from these people, starting to pick up a little point here, a little point there. So for the folks that are listening, I want to commend you for taking the time and effort and energy to learn more about this amazing of what we call the silver tsunami, all these trillions of dollars of value that's going to be trading hands, and how folks like Sreenath is taking advantage of it and providing a win-win for everyone, providing a liquidity event for the seller, providing a great business that the lender is lending on with their SBA loan, providing jobs. So Sreenath, congratulations. I look forward to seeing the rest of your deal-making journey.
Thank you so much, Colin. Thank you for inviting me. One last piece of advice to all your audience.
Please.
You just put in your effort, just do it. Things would happen. It might take time, but your grit and persistence towards getting into that path is definitely gonna land you at the right place. You will make a lot of mistakes through the process, but the idea is that, you just get a support from the community. The idea would be to minimize the number of mistakes that you make, but continue to push. There is such a huge opportunity out there. I am on to my third business. I am on LOI, and this is one of the ways you can grow the wealth. And I sincerely wish all of you can do it. There is so much opportunities for acquisition.
Amen to that. What a positive way to end the recording. So Sreenath, thank you again very much. And I look forward to, we'll have you on here after your third and fourth acquisition and get more of a insight on what you're doing in the future. So again, for everyone that listened to this, until next time, take care.
Thank you so much, Colin.